Welcome to your financial future. Build your wealth and your legacy. The Wealth Project.
Have you ever wondered why people invest for 20 years and still don't become wealthy, while others are making life-changing wealth from the same market? It doesn't make sense. They are investing in the same economy, sometimes even the same mutual funds. So what is the difference? Most people think it's because one picked a better investment. I don't think that's true. In fact, I think most people don't fail because they pick the wrong investment. They fail because they make the wrong decisions after investing. Let me show you what I mean. Imagine I put two buttons in front of you. Button number one, you make money. Button number two, you lose money. Which one would you choose? Obviously, button number one. But here is the crazy part. Millions and millions of people choose button number two without even knowing it. I'll tell you what the button is, but first, let's go back to 2020. Do you remember COVID? The roads were empty, the flights had stopped, the shops were closed, the schools were closed, the stock market had crashed. People opened their investment app. One day they had 10 lakhs return. After a few weeks, it turned to 7 lakhs. Imagine seeing 3 lakhs disappear from your portfolio. Would you be scared? I mean, of course, I would be too. Then came the news. The markets are crashing. Nobody knows when this will end. This could be much worse. So people did what they felt is right. They sold. And honestly, I don't blame them, because when you're scared, selling feels safe. But here is the part nobody talks about. While people were still scared, while COVID was still everywhere, while there was negative news all over the place, the market had slowly started recovering. Market didn't recover after everything went back to normal, but before. And by the time people started getting confidence to invest again, the prices were already up. The market didn't beat them, their emotions did. Think about that. Now let me ask you another question. Imagine your favorite phone went on a 30% discount. What would you feel? You'd feel excited, you'd tell your friends, you'll think this is a great deal, I really want to buy that phone now. But imagine your investments went down by 30%. What would you feel? Would you still feel excited? No. You panic? Why? A discount is a discount, isn't it? Here is the difference. When we are shopping, we love lower prices. And when we are investing, we are afraid of them. And that is because people stop thinking logically and they start thinking emotionally. Now remember those two buttons we initially spoke? The button number one, the button number two. Here is what they really were. Button number one, stay invested. Button number two, react emotionally. Every time you panic and sell, you're pressing button number two. Every time you chase any hot investment that other people are talking about, you're again pressing button number two. Every time you stop your sip just because markets are falling, you're pressing button number two. Every time you start thinking, I will wait for the perfect time to invest, again, you're pressing button number two. People start reacting emotionally and stop thinking logically. Here is something Warren Buffett once said. A stock market is a device for transferring the money from the impatient to the patient. Notice something, he didn't say from poor to the rich, or he didn't say from the smart to the less smart. He said from impatient to the patient. And that's a completely different lesson. Because investing is not about being the smartest person in the room. It's about staying calm while others are losing their calm. So here is my next question to you. When the market is falling next time, don't ask yourself, should I sell? Instead ask, has my financial goal changed? If the answer is no, then your investment plan shouldn't change either. Because the biggest risk in investing was never the market. It was always our emotions. And if you're in India and you would like help building a long-term investment plan based on your financial goals, your investment horizon, your risk profiling, I am Aditya Girish, an AMFI registered mutual fund distributor, and my details are up on the screen. And before you leave, I want to leave you with one thought. Most people think the wealthy become rich because they always make more money. But what if I told you most of the millionaires or billionaires, they don't even sell their investment even when they need billions of dollars. In 2022, when Elon Musk wanted to buy Twitter, he didn't sell his Tesla shares. Instead, he took a loan showing his Tesla shares as collateral. So, why would someone borrow money when he already owns billions? So, that is something that changed the way I think about wealth. This is something that we'll uncover in the next episode.